Breaking news from the Chicago Mercantile Exchange. Just hours ago, the CME halted trading on all metals futures contracts, including silver, due to what they're calling technical issues. But here's what's raising eyebrows across financial markets worldwide. This halt happened exactly 48 hours before March 1st notice day, the critical deadline when futures contract holders must declare if they want physical delivery of silver. Is this just an unfortunate technical glitch, or is something much bigger happening in the silver market? Stay with me because what I'm about to share might change how you view precious metals markets forever. We're going to break down exactly what happened today, why the timing is suspicious, and what this could mean for silver prices going forward. Today is February 25th, 2026, and the silver market just experienced a halt that has traders, investors, and market watchers buzzing with speculation. Let's dive into the facts, examine the evidence, and explore what this means for you. At 12:11 Central Time this morning, the CME's Global Command Center identified problems affecting metals and natural gas futures and options trading on their Globex platform. Within 4 minutes, at 12:15 Central Time, all trading in these markets was officially halted while support teams scrambled to investigate. Natural gas trading managed to restart relatively quickly. Markets pre-opened at 12:45 Central Time and fully opened at 12:50 Central Time. But here's the concerning part. As of this recording, metals trading, including silver, remains in limbo with no clear timeline for resumption. The exchange issued alerts stating that all day orders and good till date orders for Wednesday were being canceled. However, good till canceled orders that were already acknowledged would remain in the system. This technical language might sound routine, but the implications are anything but ordinary. CME Group Incorporated shares dropped 1.8% on Wednesday following this announcement. That might not sound like much, but for an exchange operator of this size, it signals that investors are concerned about more than just a simple technical hiccup. Let's talk about why this timing is absolutely critical. March 1st notice day falls on February 27th, 2026. That's exactly 2 days from now. This is the deadline when anyone holding March silver futures contracts must inform the exchange whether they intend to take physical delivery of the actual metal or simply close out their position for cash. Why does this matter? Because the silver market has been showing signs of extreme stress for months, and this halt happens to occur at the most inconvenient possible moment for anyone who might be caught short on physical silver with contracts they cannot fulfill. Think about it this way. Imagine you borrowed 100 cars and sold them, betting that car prices would fall so you could buy them back cheaper later. But suddenly, everyone who bought those cars wants actual delivery, and you only have access to 20 cars. What would you do? You'd probably pray for extra time to figure something out. That's essentially the situation many believe is developing in the silver market right now. Here are the numbers that tell the real story. Total COMEX silver deliveries doubled from 203 million ounces in 2024 to 474 million ounces in 2025. That's a massive increase in people actually demanding physical metal instead of just settling for cash. But February 2026 has taken this trend to an extreme level. The delivery rate is running at 98%. Let me repeat that. 98% of contract holders are demanding physical silver delivery. This is unprecedented. Normally, most futures contracts settle in cash, not physical metal. London silver lease rates tell an even more dramatic story. These rates spiked to 34.9%, with intraday peaks hitting 39%. For context, normal lease rates typically sit below 5%. What causes lease rates to spike like this? Desperate demand for borrowable physical silver. When lease rates hit 40%, it means institutions are willing to pay an absurd premium just to borrow silver for short periods. This screams one thing: there isn't enough physical silver available to meet demand. Now let's look at what happened in Asia. The Shanghai Futures Exchange reopened after the Lunar New Year holiday, and silver prices immediately surged to approximately $102 per troy ounce. Meanwhile, Western spot prices were trading around $88 per ounce. That's a 16% premium. Asian buyers are paying 16% more for silver than Western markets are showing. This massive price disconnect between East and West raises serious questions. Are Western paper prices reflecting reality, or are they artificially suppressed while the real physical market trades at much higher levels? When you see this kind of geographical price separation, it usually means one market isn't functioning properly. And given the delivery demands we just discussed, it's becoming clear which market might be the problem. This isn't the first time the CME has experienced technical issues at critical moments. On November 27, 2025, at 9:41 Eastern Time, the CME sent a one-line email to clients. Due to technical issues, futures and options markets have been halted. The cause? A cooling system failure at a data center in Aurora, Illinois, where internal temperatures reportedly surpassed 100 degrees Fahrenheit. That outage lasted over 10 hours. It happened during heightened volatility in precious metals markets. Now, less than 3 months later, we have another halt at another critical juncture. Once might be coincidence. Twice starts to look like a pattern. Market observers are noting that these technical failures seem to occur at moments when price discovery might expose uncomfortable truths about physical availability versus paper obligations. JP Morgan and several large United States banks reportedly still hold significant short positions in silver. These are positions betting that silver prices will decline. But here's the problem. If delivery demands continue at current rates and physical silver supplies are as tight as the evidence suggests, these short positions could face a squeeze of historic proportions. What is a short squeeze? It happens when traders who bet on falling prices are forced to buy at higher prices to cover their positions. This buying pressure drives prices even higher, creating a vicious cycle. The higher prices go, the more shorts need to cover, pushing prices higher still. Many market participants believe large institutions have been suppressing paper silver prices to create conditions for accumulating physical metal cheaply. But if delivery demands overwhelm available supply, this strategy could backfire catastrophically, and a well-timed trading halt might provide breathing room to manage that risk. Here's where things get really interesting. COMEX registered silver, the category actually deliverable against futures contracts, sits at approximately 88 million ounces. Total exchange inventory is around 366 million ounces. The remainder is classified as eligible but not formally pledged for delivery. So while the exchange can point to 366 million ounces of silver in vaults, only 88 million is actually available for immediate delivery. If March contract holders demand more than 88 million ounces, where does the additional silver come from? This is the question causing anxiety throughout the market, and it's the question that makes today's trading halt so suspiciously timed. With March 1st notice day just 48 hours away, the exchange and its largest participants need to know exactly how much physical delivery will be demanded. A trading halt prevents that information from emerging when it needs to emerge most. Whether you own silver, trade silver futures, or simply watch precious metals markets, today's events matter. They suggest the paper silver market may be approaching a breaking point where physical reality can no longer be papered over with financial engineering. If the silver market is genuinely facing a delivery squeeze, prices could move dramatically higher once trading resumes. Conversely, if this is simply a technical issue as claimed, markets should resume normal function without major disruption. Watch carefully what happens when trading restarts. The speed of resumption and price behavior will tell us a lot. For physical silver holders, this situation reinforces the value of owning metal outside the futures market system. Paper promises mean nothing if physical delivery cannot be fulfilled. For traders, the risk-reward dynamics in silver futures have clearly shifted given these delivery pressures and operational uncertainties. For everyone else, this is a reminder that markets are fragile systems. Technical failures happen, yes, but they happen most conveniently when underlying fundamentals are stressed beyond normal parameters. Today, February 25, 2026, the Chicago Mercantile Exchange halted silver futures, trading 48 hours before March 1st notice day. Whether this is a genuine technical problem or something more strategic remains to be seen. But the context cannot be ignored. Record delivery demands, extreme lease rates, massive Shanghai premiums, and a pattern of convenient outages all point toward a market under severe stress. Watch what happens over the next 48 hours. If trading resumes smoothly and first notice day passes without incident, perhaps this was truly just bad timing. But if we see extended delays, unusual rule changes, or other irregularities, the silver squeeze narrative will gain significant credibility. The key question remains simple. Do the shorts have the silver, or will they be squeezed? We're about to find out. Stay alert, stay informed, and make sure you understand the difference between paper promises and physical metal. Subscribe for updates as this situation develops. This is a critical moment in precious metals markets. Don't miss what happens next.